in the last few lectures, we were discussing about the financing decision. And as you are aware, that financing decision is one of the function of finance. In financing decision, we are supposed to take the decision that how much fund is required and what are the various sources from where the fund has to be generated. Along with that, the important decision is that what should be the mix of the finance. That means how much fund we are supposed to generate in terms of shares and how much fund we are supposed to generate in terms of debts, because we have discussed that both shares and debts, they are having their own merits and demerits. But the company wants the optimum advantage from the sources. The company has to go for mixing the proportion of the capital in between equity and share. In the last few lectures, we have discussed about the basic concept of leverage, and the numerical portion also we discussed. We are aware that in leverage we take up the relationship between the variables, and there will be three types of leverage: operating, financial and combined leverage. A number of times I have told you, and we have discussed also, that leverage helps us in understanding the relationship between the variables. That means they are measuring the relation between the variables. They are not measuring the variables, but they are measuring the relation between the variables. And secondly, from leverage, we also come to know that what is the risk percentage existing in the company. So as we have seen that with the existence of fixed cost in the income statement and capital statement, the earning per share is going to increase, but along with that, the risk on the company is also going to increase. Today also we will take up one numerical which will give you the overview with respect to operating, financial and combined, and we will try to interpret the result that which company in which situation it is good. The ideal situation as well as the risky situation that we will try to interpret from the combination of the companies that we are having. A brief information about the problem has been given. A company is there, any company you can take. The company is having the production of 800 units. The selling price is given as rupees 15 per unit. Variable cost is given as rupees 10 per unit. But fixed cost, we are having three situations for fixed cost. Situation A, B and C. 1000, 2000 and 3000. And along with that, the information has been provided with respect to financing for the company. That means company can go for financing for plan A, plan B and plan C, or we can say plan 1, plan 2 and plan 3. There are three plans which the company has for financing. As you are aware that total funding is 10,000. Total funding is 10,000. In plan 1, company can bring 5,000 and 5,000 from equity and shares. Equity and debt. In plan 2, 75% from equity and 25% from debt, and reverse is there in plan 3. And we are supposed to find out the highest and the lowest of combined leverage. That means, first of all, we have to calculate the operating leverage, then financial leverage. Automatically, we can land to the combined. One thing more. In operating leverage, you are aware we are concerned with fixed cost. In operating leverage, you are concerned with fixed cost. And fixed cost is given in three forms. Situation 1, 2 and 3. That means we will able to calculate operating leverage, and there will be three operating leverage. Operating leverage for situation 1, situation A, B and C. In the same way, when we move toward the capital structure, we find the company is having three plans. And when we are having three operating leverage, and as you are aware, while we go for finding the financial leverage, we start with EBIT. That means we will be having three EBIT also. Three EBIT with respect to three plans. That means there will be three situations having three EBIT. Means EBIT for situation A, EBIT for B and EBIT for C. And the same way, A situation will have plan 1, plan 2 and plan 3. Situation B EBIT will have plan 1, plan 2, plan 3 and respectively C also. That means in totality we are going to have 9 combinations of this. And then we can discuss about the highest and the lowest combined leverage. That means when the company is having the maximum benefit and which is the ideal situation or which is the riskiest situation for the company. So first of all, we will make an effort for calculating operating leverage and with respect to three situations. That means situation A, B and C. These are three situations which are available to us. Sales. Sales is given as 15 rupees and number of units is 800. So how much is sale? 12,000. 12,000 in situation A. So sales is having 12,000 and that will be same for all three situations. 12,000, 12,000 and 12,000. We minus the variable cost, and variable cost is given as rupees 10. That means 8,000. So 8,000 will be variable cost in all the three situations. We get contribution. Sales minus variable is the contribution. And contribution is 4,000, 4,000 and 4,000. From this, we minus the fixed cost. And fixed cost is given for section A, B and C. That means 1,000. From here we are differentiating. And as you are also aware that OL exists if the fixed cost is there. 2,000 and 3,000. That means it will be 1,000. 2,000 and 3,000, and this will be your EBIT. We try to make an effort for calculating the operating leverage. And operating leverage is 1.3. Operating leverage is what is the equation for solving the operating leverage? That is contribution upon EBIT. Contribution upon EBIT. 4,000 upon 3,000. How much? 1.33. 1.33. 4,000 upon 2,000 it is 2. And 4,000 upon 1 it is 4. This is your operating leverage. Situation 1, 2 and 3. Right? Okay. Now we try to calculate the financial leverage. And again I remind you that financial leverage has to be calculated for three operating leverage having the three plans. That means we have to divide our structure in plan 1, plan 2 and plan 3. We can say plan 1, plan 2 and plan 3. And we have to calculate the financial leverage in this case. Financial leverage, and we can say situation A. So first of all, we have to take situation A. In situation A, the EBIT is 3,000. That will remain same for all the three plans. So EBIT 3,000, 3,000 and 3,000 minus interest. Interest in plan 1, interest is 12%. 12% of 5,000. How much?
600.
600. So 600 interest will be there in first plan. 12% of 2,500 will be half. 300. And 12% of this, that will be 900. This is your profit before tax. This is your profit before tax. It will be 2,700.
400, sir.
Okay. 2,400. 2,700. And it will be 2,100. Right? This is for situation A. In the same way, we have to calculate for B and C also. Or rather say, first of all, what we can do? That first of all we can calculate the financial leverage. And financial leverage means EBIT upon PBT. That is EBIT upon PBT. 3,000 upon 2,400. How much?
1.25.
1? एक जना बोले
1.25.
1.25. 3,000 divided by 2,700.
1.11.
1.11. And 3,000 divided by 2,100.
1.42.
1.42. 4. Right. This is over. Situation B. EBIT for situation B, we are having as 2,000. 2,000 and 2,000 minus interest. Interest is same. Interest will be same, that is 6, 3 and 900. 600, 300 and 900. 1,400, 1,700 and 1,100. This will be your PBT. That means financial leverage. What will be financial leverage?
1.42.
1.42. In the second case?
1.17.
1.17. Third case? 2,000 divided by 1,100.
1.81.
1.81. So situation B, we are having three financial leverage: 1.42, 1.17 and 1.81. So this is for situation A and this is for situation B, financial leverage. In the same way, we make an effort to calculate for situation C. Situation C. And EBIT for situation C is 1,000. 1,000. 1,000 and 1,000. Minus interest. Interest we are having 600, 300 and 900. That means profit before tax we are having as 400, 700 and 100. And financial leverage 1,000 divided by 400.
2.5.
2.5. 1000 divided by 700.
1.42.
1.42. And this will be
10.
10. 10, 1.42 and 2.5. Now, and as you are also aware that combined leverage is the combination of operating leverage and financial leverage. How to draw the chart? We are having plan 1, plan 2 and plan 3. And we are having 3 situations. A, B and C. Situation A, we are having as operating leverage. In situation A is 1.33. Situation A is 1.33. In B it is 2. In B it is 2 and in C it is 4. It is 4. Right? That means this will prevail for all the 3. 1.33, 1.33, 2, 2, 4 and 4. Now financial leverage for plan 1. Financial leverage for situation A, it is plan 1 multiplied by 1.25. It is 1.11 in plan 2. 1.11. It is 1.42 in plan 3. In situation B, we are having plan 1, 1.42 multiplied by 1.42. 1.17, 1.17 and 1.81. Right? This is the way how to write systematically. There will be no confusion. First you drop out all the operating leverage and then catch the situation and put the figure of plan 1, plan 2 and plan 3. And here in plan C we are having 2.5 into 2.5, 1.42, 1.42 and 10. Because as we are aware that we are trying to calculate the combined leverage. And combined leverage is equal to OL multiplied by FL. So we have taken the OL of all the 3 situations A, B and C and FL of all 3 plans with respect to 3 situations. Now 1.33 multiplied by 1.25.
1.66.
1.66. 1.66. 1.33 into 1.11.
1.47.
1.47. 1.33 into 1.42.
1.89.
1.89. These are the circle 1 are the combined leverage. For B, 2 into 1.42.
2.86.
2.86. For plan 2,
2.34.
2.34. And 2 into 1.81.
3.62.
3.62. 3.62. Very good. 4.25. 10. 4.1.42.
5.68.
5.66.
6.
And this is 40.
4.68.
68.
Yes, sir.
68. And this is 40. So you can see that we have got 9 combined leverage for situation A, B and C with respect to 3 plan 1, plan 2 and plan 3. Now the highest is this. And the lowest we can say, lowest is 1.66. 1.47. Right. 1.47. That means if the situation prevail is C, in situation C, if we go for third plan where we have 2,500 as share and 7,500 as debt, then that combination will be riskiest combination for the company, because here the combined leverage is coming as highest. So we can say situation C combined with third plan will be the high risk. Situation C combined with third plan, and situation A when it is combined with second plan. Situation A when it is combined with second plan, this will be ideal situation, or ideal we can say the low risk. You can also say as the low risk. So in this way, if the company is having, if the company want to go for gaining more, the company has to take more risk. So for that situation, the company has to go for third capital structure planning. But if the company want to play safe, no risk or less risk, then company can go for second plan, and situation A will be considered as a fixed cost. So in this way we can say that we have tried to make an effort to calculate the operating leverage, then financial leverage, then combined leverage, and interpretation has also been provided. Right? Okay students. Till now, the income statement was provided to us. Whether we say the cost statement, the income statement was provided. That means the information regarding the sales, contribution, variable cost, fixed cost was given. And then we were able to derive the earning per share. In this case, the income statement is not provided, but we are supposed to prepare the income statement, and after preparing the income statement, then we are supposed to calculate the earning per share. But in between, the filling information they have provided, like the PV ratio is given as profit volume ratio, is given as 40%, operating leverage as 1.5, financial leverage as 1.421, interest is provided as 8,000, tax 30%, and number of equity shares the company is having as 10,000. And the problem says that we are supposed to find out, or we are supposed to lay out the income statement. And when the income statement has been prepared, easily we are able to calculate the earning per share. देखते हैं, effort उठाते हैं इसमें. So first of all, we can say EBIT. Okay. Financial leverage is given. Financial leverage is equal to, as you are aware, EBIT upon PBT. Means we can say EBIT upon EBIT minus interest. Interest is given as 8,000 and financial leverage is given as 1.421. That means you can write in this way, 1.421 is equal to EBIT upon EBIT minus 8,000. You do the mathematics part. I am aware about the outcome. Later on you can solve it also. When you solve this equation, then EBIT will come to as 27,000. Left hand side, right hand side, that combination that you do by yourself. So EBIT we have arrived at 25,000. Now PBT. PBT also can be calculated because PBT means EBIT minus interest. PBT is EBIT minus interest, and EBIT is 27,000 and interest is 8,000. That means 19,000 is the PBT. Right? This information we have calculated. Now we take operating leverage. We take operating leverage. Operating leverage is contribution upon EBIT. We are aware about operating leverage, that is 1.5. EBIT is 27,000. EBIT is 27,000. That means contribution. Contribution means we can say OL is EBIT is 27,000 multiplied by 1.5. It will come to us how much? 27,000 into 1.5. 40,000.
4,550.
250. It will come to 40,000. 500. 40,500. So this is your contribution. Then fixed cost information is not provided as contribution is known. Like the contribution is known, then we can calculate the fixed cost also. And as you are aware that sale minus variable cost, sale minus variable cost, or we can say interest is not given, fixed cost. Variable cost, it is given as contribution minus fixed cost. It is given as EBIT. Right? EBIT is known, contribution is known, fixed cost can be known. So we can say fixed cost. भाई यही तो स्ट्रक्चर होता है ना आपका जो हम लोग करते हैं इनकम स्टेटमेंट इसे हम लोग कहते हैं. So where we are having EBIT. EBIT is 27,000 and contribution just now we have calculated 40,000. That means contribution is 40,500 minus EBIT is 27,000. How much? How much? 13,500. 13,500 is the fixed cost, right? So, okay. So this information we have exhausted. This is also there. This is also there. Then we have PV ratio. We have PV ratio. PV ratio is contribution upon sale. That means we can derive the sale. We can derive the sale. That means sales. Contribution upon sale. That means it will be contribution into PV ratio. And contribution is 40,500 multiplied by PV ratio is given as 40%. That means 0.40. How much? 40,000 into 0.4?
60,200.
60,200. 60,000. 250. 60,200. 16. Okay. It will come to as 16,000. 16,200. Right? So sale has been derived. Now what is left out? If I say variable cost is left out, and variable cost
Divide में
ये डिवाइड में आएगा. Right. So again we take up that profit volume ratio is contribution upon sales, then sale can be written as contribution divided by PVR. Contribution divided by PVR. So contribution is given as, here we have calculated the contribution. It is 40,500 divided by 40%. How much? 1,01,250. 250. This is your sales. We can calculate the variable cost also. And as you are aware, that sale minus variable cost give you contribution. Contribution is known, sale is known, variable cost can be calculated. So we can say variable cost. Variable cost is sales. That is 1,01,250 minus contribution, and contribution is 40,500. It will come to us 60,750. This is your variable cost. And now I suppose all the heads of income statement has been calculated. Like sales, we are having as 1,01,250 minus variable cost 60,750. Contribution, it will automatically come as 40,500 minus fixed cost. Fixed cost we have calculated here itself somewhere. Fixed cost is 13,500. We get EBIT. EBIT we have calculated as 27,000. Automatically the information is being verified also. Minus interest. Interest is given in the problem as 8,000. We get profit before tax calculated as 19,000 minus tax. This is given as at the rate of 30%. You calculate 30% of 19,000. 5,700. 19,000 minus 5,700. 13,300. So 13,300 will be called as profit after tax. Earning per share is profit after tax divided by number of shares. And profit after tax is 13,300 divided by number of shares as 10,000. That means earning per share will be 1.33. Right? So in this way, the information with respect to operating leverage and financial leverage was provided, and from that we have derived the income statement itself, and the figures have been verified also. Right? Okay, thank you all of you.